Hey, this is Todd with YesTodd.com, also the Affluentology.com web series, and just wanted to walk through how to read your closing disclosure. So there's a lot of information on here. Some of it gets glossed over when it comes time to close on a loan. So if you get your closing disclosure and you're curious to know who's making what as far as income is concerned and where the commissions are listed, and is my earnest money accounted for, and who's covering the taxes, and that kind of information, walk through this video side by side with your closing disclosure, and it'll give you all the details. So, all right, we've got a deal, and I just scrubbed it a little bit. It was from 2024, where the purchase price was $940, the loan amount was $846,000, interest rate 6.25%. So this is the principal and interest, does not include the taxes, the insurance, the escrow, all that kind of stuff. All in this payment is going to be about $6,000 with the escrow. And then it goes to show you how much is in taxes and insurance. So the total monthly payment is here. The principal and interest only is up here. And it comes up pretty nicely with the total cash closing costs and the total funds to close. I wish they would change that to funds because it's not cash, but whatever. That's just me being me. Now, the closing costs, however, when you look at this, you're like, holy smokes, $9,000 in costs. Well, that includes almost $10,000 in loan costs, plus $9,000 in other costs, less a lender credit of about $10,000. So the mortgage actually was free, quote unquote. And I'm displaying that in a different video on how mortgage pricing works. And I think you can access that by clicking on this link up here. But nonetheless, this essentially breaks down in this fashion. Okay, so the origination charges are that is the income that is going to go to the lender or the broker. So sometimes it shows up and paid by others. Sometimes it shows up on here. If you're at a retail bank, they can hide this from you a little bit and they cook it into their interest rate. So if this is a retail banking organization, those big boys that you're familiar with the massive overhead, this is probably a 7 instead of a 6. That's the biggest difference. This is an example from an independent broker. That's why you see a broker fee here. So the total mortgage broker compensation for the company has to be listed, and it's $84.60 on this deal. Now, in addition to that, there is an appraisal that was paid for before closing, and the credit report was paid for before closing. And there is a third-party processing fee that was paid by the lender right here of $495. Then there were title fees that were accrued for. Normally in the state of Colorado, it's about $1,500. The reason this is only $550 on this one is because the lender also paid $675 of it over here. So this is the gross revenue, and then you can see where money is coming off of that as we go down here on the paid by others, right? So then we've got our subtotal of all costs here, the taxes and government fees in order to record the deed and the mortgage, and then the tax stamp. In Colorado, it's 1 penny per thousand of the purchase price. So the reason this is $94 is because the purchase price is $940,000. Pretty simple math on that one. Then we've got your hazard insurance. So hazard insurance we collect oftentimes if you're escrowing, which most mortgages are, 1 year's worth of your insurance premium up front. Then we collect monthly, so next year we can pay 1 year of your insurance up front again. If that makes sense. So that is a cost. So are taxes. So they're not lender costs. Your loan officer or your mortgage company isn't charging you. The insurance company is, but they're costs to acquire the loan, right? So we collect that up front. Then there is an interim interest. So this guy closed, and this is about perfect, the middle of the month. So it's kind of like pick a number between 1 and 10. You pick 5, so you're halfway there. So you do not have a mortgage payment the month after you close. So on this deal, he's going to close in July. So if you looked at it this way, here's how this works. Come on, dude, move. All right. So this is July, this is August, and we move on month to month to month, right? So we're closing right here. Well, you can't make a partial mortgage payment. Mortgage payments are made in arrears. So this is 7, and this is 8, and this is 9. The first mortgage payment is not in August, it's in September. And in September, you pay because you just lived in the property in August, right? So when you close at the middle of the month, you bring in the remainder of the month of July. That's why you don't have a payment in August. That's why your first payment is in September. This money right here that you're bringing in to not have the August payment, that's what this is right here. It's basically the August payment of interest. In this case, $145 a day. Now, they're also going to set up an escrow account, like I had mentioned, to pay the taxes and the insurance next year. And when we're looking at that, it's $286 a month. They're going to collect 3 months. Why? Because they want a 2-month cushion. So why are they collecting 3? Because we're not making that payment in August. We're not making a payment till September. So when we don't make the payment in August, that's the 1. Then there's the 2-month cushion. Same thing goes with property taxes. I'm not going to get into an aggregate adjustment, but it's kind of stupid how it works. They say they're collecting 4 months and giving you a month of credit back here, dollar for dollar. It works exactly the same in taxes. We want a 1 month cushion, and we're not making the payment in August. By the time you make the payment in September, you've got your 2-month cushion. So, all right, HOA dues to the neighborhood. And a transfer fee that the HOA is going to charge to transfer the information from seller into buyer's name. And then we've got our real estate commissions. The listing agent on this $940,000 purchase made $17,000. The buyer's agent made $25,000 plus, right? Those are coming down and being changed a little bit. What's funny about it, in my opinion, is it's a seller paid cost, but of course it's rolled into the purchase price, right? So if you weren't paying those commissions, basically you could have bought the house for $900, but you can't. The realtors earn their money. They did their job and they got paid for it. This is what you as the buyer agreed to pay them when you paid $940 for the house. Okay. And then there's a water setup fee or whatever, in this case of $41. So when we looked at all of this, you can see what the total of all other costs were. The other costs are just this, the government fees and the taxes and the insurance and any HOA dues. That's the $9,000 that we've got here. When we roll back up, you can see, all right, that's the other costs. It includes the $9,910 in loan costs, and there's a credit of $9,911 in lender credits to wipe that out. Then, all right, on to page 3. This loan estimate, we had the total closing cost. This is kind of the report card. Like, was I being given an accurate estimate? Well, we estimated about $11,000 in total cost, and it ended up being $9,000. They paid $900 beforehand. That was the appraisal and the credit report. Down payment was the same. Earnest money was the same. They got a seller credit of about $2,000, and there were some other adjustments that we didn't account for. So the funds to close went from $95,000 down to $86,000. Now, let's take a look at this. Here's where I always check this to see, all right, is the earnest money on there? Is my loan amount on here? You can kind of look at this. The total amount due to buy the house is $948,000. It's $940 for the purchase plus those closing costs. The amount that's already sitting there waiting for you is $861. You've got your deposit, your earnest money, that's $10,000. You've got your mortgage, that's sitting there, and you got a seller credit of $2,000 sitting there. In addition, you've got the taxes. So on this one, and it's always going to be in section L, line 13. You want to look for the county taxes to make sure that the seller is responsible to pay the taxes on the property until the date of closing. Now, taxes for 2024 are paid in 2025. So on this deal, when the taxes come due in 2025, the current buyer is going to pay for all of it. But they received a credit from January 1st through July 16th from the seller the day they bought it. This is the percentage of taxes or the dollar amount of taxes that the seller owned the property for until this date, and they paid at closing to the buyer. So when we look at this, you're like, all right, it's pretty simple math. The total amount due is the $948.83 that we see right here. The total amount sitting in a pile waiting for you at the closing table is the $861,437. That gives you the remainder, the $86,646 is what they're going to bring to the closing table as funds to close. So this is everything that you would ever need to know in order to determine if your closing disclosure is accurate and makes sense to you. So hope that helps. Any other questions, feel free to ping us and let us know what we can do for you. All right, man. Thanks. Take care.